Good morning, everybody, on this Quint's birthday Monday. Like to welcome everybody to this webinar today on our global long-term value and our high income value fund. And I'm going to be going through quite a lot of slides today, but I'd like to get some housekeeping out of the way first. If you want to ask a question, there's a little hand icon on your top right. You can click on it and type your question. As I've got a lot of slides to get through today, I'll endeavour to revert back to the questions at the end of the presentation. So I won't be taking questions through the webinar. I'll remit to them towards the end. It's just we've got a lot of content to get through, and we've only got 60 minutes, so I'm going to try and get through as quickly as possible. In every talk that I give, I always start by explaining the investment doctrine and I guess the investment tenets, and really all of what we do, our capital deployment process, our investment, is really tied to this really important slide. It's probably the most important slide of the entire presentation, but it's a slide that I always repeat in every single talk, every single speech that I do, because if you understand this slide, not only will you understand our investment philosophy and the tenets that we uphold, but I think you'll become a far better equity investor. When most people think about equity investing and they think about shares, most investors think of it as some sort of abstract financial instrument. They see a share price on their screen and they see it flash across their iPhone. And really, with the advent of modern technology, the underlying concept of what an equity investment is has really been deracinated. An equity investment is a participation or a stake in a business partnership. And it doesn't matter whether you buy 0.2% of a company or you buy 20% of a company. The underlying economic, legal and commercial relationship that binds you to the company is really that of a business partnership. And that's something that at Microequities is a core tenet. We walk the walk and talk the talk. And a lot of our investments, some of our business partnerships that we own today, we've held for over 8 years. So when we think about a potential investment, we're not asking ourselves what this business, what this company will look like in the space of 6, 12 months from now. To us, we're asking ourselves what this business will look like in 5, 6 years from now. Because for us, it is tantamount to a business relationship. Every time we're buying equity, every time we're deploying capital, it is a business relationship, a business partnership that we're taking on. And if you think about, a friend or a colleague that asked you to become a potential business partner, you wouldn't fathom entertaining a relationship of that kind with a view of 6 months or 9 months. But yet when people buy shares, when they buy equity in publicly listed companies, they think of it as in a very short-term myopic terms of reference. That's not what we do, and hence it's really important that you understand this, because when you're buying shares in ANZ Bank or Woolworths, what you really should be thinking about is what ANZ will look like in the space of 5, 6 years, 7 years from now. You shouldn't entertain buying equity or equity investments with a view of a 6 to 12 month time span. So this is really a critical slide, and it really forms the conceptual framework for our capital deployment process, and it's at the core of our investment ethos. It's a really, really important slide. So given that we defined an equity investment as a business partnership, this other slide differentiates the intrinsic value and the market value, and a lot of investors confuse them in the sense that they think that intrinsic value equals market value. That is, they define the value of a company merely through reference to the share market price, the market value, and that is incorrect. Microequities is a value investor, and one of the key engines for our performance is the fact that the market does not calibrate the intrinsic value properly, and certainly not between the short and medium term. That is, there can be large variations in between the intrinsic value and the market value. If you think about what market value is, it is the price at which buyers and sellers are currently transacting a stake of that business partnership. But the intrinsic value is the actual true value of a business at any given point in time. And we know for a fact that the stock market is a flawed value of intrinsic value, certainly over the short to medium term. And we know that most of the time, the market value does not equate to the intrinsic value. There are misvaluations all the time. There are both overvalued companies and there are many undervalued companies. So it's important to understand that there can be large variations between the two. At Microequities, we're extremely focused on the intrinsic value. We're assessing at any point in time what the true value of a business is worth. And when we're looking at a potential investment, we look at the intrinsic value and then we look at the market value. And if a significant gap exists between both of them, and that company has a whole set of other quality criterion that we're looking for, then we will enter into a long-term business partnership. Of course, we're talking about microcap companies, and some of you may not be aware of what a microcap company is. A microcap's somewhat of a loosely defined asset class, but we defined a microcap company as a company that has a market value of under $300 million. Before I leave this slide, I want you to understand that the compass that we look at and how we gauge the quality and the evolution of our business partnership is not through market value. We could buy a business today and the market value of that business could fall 30% over the next 12 months and it would not bother us so long as the intrinsic value of that business was rising. And that may seem like a strange phrase to state, but if you think about the earlier slide, if you thought about a business partnership, what you care as a business partner is the underlying fundamentals of the business. So if you own a chain of pizza restaurants, what you actually care is not the market value for this chain of pizza restaurants, but the profitability of each store, the margins, the quality of the client base, the competitive market structure. But the underlying intrinsic value of that business will be defined through the cash flows that each of the restaurants own. And hence, so long as the intrinsic value is rising, we're not concerned as what the market value might be doing. We do know that over the long term, the divergences between the intrinsic value and the market value will converge, such that intrinsic value will approximate market value. But you should be very aware that over the short to medium term, and medium term might be 24, 36 months, the market can be an awful value of intrinsic value, and hence you shouldn't be following the market value as a proxy for the underlying fundamentals of a business. That should not be your compass. Your compass should be the intrinsic value of a business, because that's a much more reliable measure of the true value of the business. That is your true value of the business. And to give you a tangible example of this, divergence between intrinsic value and market value, I've put up this chart of Telstra, which is obviously not a microcap company, but it is going to elucidate this divergence between the intrinsic value evolution and market values. So you've got here a histogram which is showing the earnings per share of Telstra each year, and we'll take that as a rough proxy for the intrinsic value and the intrinsic fundamentals of Telstra as a business enterprise. So you see that over the last 20 years, the earnings per share of Telstra has been pretty stable. It's actually, if you go back to 1997, the earnings per share of Telstra was approximately 30 cents in the dollar. That's the axis on your left. It reached an all-time high roughly in 1999 when the earnings per share had barely moved. And then you see a significant price depreciation in Telstra between 1999 and 2005, the price of Telstra, the market value of Telstra fell by 75%. Yet, if you were actually just looking at the earnings per share, the profitability of Telstra divided by the number of shares on issue, the earnings per share, you will see quite a stable relationship in Telstra's earnings per share. So people have this erroneous concept that equity investments are volatile because they see these large gyrations in market value. In reality, equity investment is not so volatile because the intrinsic valuation of Telstra hasn't really moved up or down much over the last 20 years. It's actually been quite a stable intrinsic valuation. So people think of equity investment as being inherently risky because of this market valuation fluctuations. But if your true compass was actually the intrinsic value, which it is at Microequities, it's a relatively stable investment. And hence, the conclusion from this chart is that market values are volatiles and intrinsic values are nowhere near as volatiles. So if your compass is the earnings per share as a rough proxy, if it is the fundamentals of the business, you have to look at these violent market fluctuations with a certain degree of equanimity. You should be removed from the noise of market value, which can be driven over the short to medium term by a whole host of factors, such as sentiment, supply, demand of equity, risk tolerance, a whole set of very complex exogenous variables. You should remove yourself from that and focus on the intrinsic valuation of the business. And if you think back to the first slide, that should be your only concern as a business partner, the underlying health of the fundamentals of a business. So what does Microequities seek to identify when we're investing? Well, none of us in the investment management team have any geological expertise, so we let other people invest in mining and resources because we think they'll do a better job than us. We only invest in industrial businesses, and we define a business as an economic enterprise that actually delivers an operating profit. That is, there is an economic rationale that's been justified and validated that underpins the existence of that enterprise. To us, if a company is making losses, we don't define that as a business. We define that as a project. You get to be entitled to be called a business once you actually start delivering the profit. And hence, we're not interested in allocating capital or entering into business partnerships with projects. We only do that with profitable business enterprise. So we focus on industrial businesses that are all profitable. They must be profitable and generally have to have at least 2 consecutive years of operating profitability. Now, what ultimately drives long-term returns is the intrinsic valuation. So in order for the intrinsic value to rise, the company must have a credible and probable long-term growth pathway. That is, when we think about the potential business partnership in 5, 6, 7 years from now, we would like to think that the business is going to be substantially larger in terms of its revenue, in terms of its earnings generating capability and its free cash flow. Businesses that we like to invest in should have either no debt or very little debt. Most of the business partnerships we allocate capital to have net cash assets. The ones that do have net debt have debt ratios below debt to operating profit of less than 2 times. And hence, most of the businesses we own are able to fund their growth capex, their growth capital expenditure internally from cash flows from operations. They're not reliant on the generosity of capital markets and the banks in order to finance their long-term growth. And that makes them self-sufficient and self-reliant. What it also does is it removes a significant amount of financial risk from the investment. We only look at businesses whose models we understand, because if we can't understand how the business generates profit, how it generates income, we're not going to be able to value. So we only invest in businesses that we understand. We're looking to make an investment when we've assessed the intrinsic valuation of a business to be at least 50% premium, at a 50% premium to the current market value. And a lot of the time, that intrinsic valuation premium is greater than 80, sometimes even greater than 100%. So we're looking at scenarios where the market value, keeping in mind that the market over the short to medium term can be an awful valuer of businesses, where the market has got it wrong and simply is mispricing, it's undervaluing the business. And this allows us a very strong investment opportunity by making an assessment on the true intrinsic value of the business and profiting from the myopic or erroneous valuation that the market has assigned. This is all part of a value investment doctrine. And so how do we go about this investment process? What do we do? Well, we do research, and we're constantly researching businesses that we don't own. We spend probably 90% of the time on the business partnerships we don't own, on potential business partnerships. And once we've gone through, there's in the ASX, there's 2,300 listed companies. 1,600 of those would be microcap companies. That is, companies with a market value below $300 million. But once you assign a profitability filter or a criteria, that really shrinks your investment universe to about 600 companies. And at Microequities, our investment management team look over all of those companies. And once we're finished going through those 600 companies, we then look at everything again, because businesses are dynamic in nature. The world and business is always in a constant state of flux. Nothing stays constant and everything changes. So you need to reassess the business, reassess the valuation, and go through the fundamentals again. And once we've finished step 2, we repeat step 1 and step 2 incessantly. And that's all we do. We keep looking, reviewing, looking, reviewing. It's a constant, endless loop of research and continual assessment. And you have to do that in order to make sure you've identified the best potential opportunities. So I'm going to give a little bit of background on Microequities. We were founded in 2006. Microequities is a public unlisted company. We've got circa 40 shareholders. We've got a full-person board of directors with 2 non-executive independent directors. We have 15 employees, and we've got a 4-person investment management team. I'm going to focus a little bit on the investment management team, because I think when you're investing into a fund such as ours, what you're really investing are 2 things. You're investing in the investment doctrine or the investment tenet that the fund manager upholds, and the team that actually executes that investment tenet, that's your second component of what you're investing in. And I think one of the qualities of a lot of boutique fund managers is that they possess really, really long-term key principles in the investment management team. And that is because the biggest causality of key person within the funds management industry, key person churn within the funds management industry, is poaching. That is, it's not somebody being hit by the proverbial bus, but it's actually it's somebody poaching key talent within the investment management team, or the investment management team jumping ship. Very happy to say that the 3 key senior people in our investment management team have all had extremely long tenures at Microequities Asset Management Team, and those 3 members, including myself, obviously, hold equity in Microequities. This minimises the risk of poaching and has made for a very stable, long-term investment management team. Currently, Microequities is managing $365 million in funds under management, and that figure in itself, I think, is quite inane. It doesn't really say much. I mean, I could be saying 200, I could be saying $800 million. It doesn't really mean much. It's just a number. But the figure that I think is really important is the fact that 25% of the funds under management are owned by the staff, shareholders, and directors. Just over $90 million of our own assets are sitting alongside our fellow co-investors. And in that group, the staff, shareholders and directors make up by far the biggest cohort of investors within Microequities Asset Management. So that provides an extremely strong alignment of interest with our fellow investors. And what it also does is it creates an extreme focus on downside risk, because every time we're making an investment or an investment decision, every time we're allocating capital, we're entering into a business partnership and we're putting our co-investors' funds at risk, we're also doing that with our own personal funds, and substantial amounts of our personal wealth are tied up in product alongside our co-investors. So I think it's a really key, strong attribute that you should know, that you're investing alongside all the key principals, the directors, the staff, and the shareholders. I'm going to start to talk about our two funds, which are the purpose of today's webinar. The first one I'm going to be discussing is the Global Value Microcap Fund. Now, this fund has only really been running for a very short period, just over 18 months, and hence typically I would never be referring to a 12-month return because I never make reference to short-term performance. It's irrelevant. This is about a 5-year plus investment term, and hence we look at much more long-term investment returns. But given the fund's only been around for 18 months, I'm left with no choice but to make reference to these short-term return numbers. The fund was launched 18 months ago, and the fund's mandate is very much like our flagship Deep Value Fund. It is a capital growth fund, and it seeks to identify undervalued, profitable industrial businesses that have at least 2 consecutive years of profitability, that have balance sheets with no debt or very little debt, and that the investment management team has assessed that those businesses have credible and long-term growth pathways, because that's what will drive our investment performance over the long term. And the fund invests in businesses that are well understood by the investment management team. So sometimes I get asked, how are we able to identify, a business that's sitting in the UK? How are we in Sydney able to identify that business? What key information or what capability do we hold in making that assessment? The reality is that we live in a global, interlinked economy, and most of our domestic business partnerships have international businesses in their own right, and most of our domestic business partnerships are exposed to foreign competitors domestically. Hence, there is an interlocking, weaving between the global economic capitalist structure that allows us to see foreign companies in our shores and also our own domestic companies competing in international. So when we're assessing, for example, Webjet, which has an international, has vast international operations, we have to come across the international competitive landscape that Webjet operates in the UK and Asia Pacific. And also domestically, Webjet's competitors are, a lot of them, American competitors, North American competitors. So we have to come across Webjet's international competitors. So in our global value market cap, for example, we own 3 online travel agencies, and we have very, very strong experience in investing in online travel agencies, because not only have we owned Webjet, and we own Webjet in our Deep Value Microcap Fund, but we own What If in our High Income Value Microcap Fund, which is eventually bought out by Expedia. So in our Global Value Microcap Fund, for example, we own 3 online travel agencies, and we have a capability and deep-rooted experience in being able to assess online travel agents' business models. We're across the growth dynamics in each of the geographic markets across the world. We're across the competitive landscape in each of those regions, and we understand the nuances of those businesses. We do a lot of elbow desktop research in any business, whether it's international or local. We speak to the management teams, whether it's domestic or international. I'll be traveling to London next month, and I'll be meeting with 20 business partnerships, 5 of which we own and 15 that we've been profiling for the last 12 months. So the investment process is exactly the same as in our domestic funds, but equally, and this is probably the most important, the investment doctrine and the investment principles that we uphold and the execution of those is exactly the same. And really what drives our long-term investment performance is that strict adherence to that disciplined execution of our value investment doctrine. I will say something about the performance. This performance, whilst it's a double-digit performance, is really being masked by the strong Australian dollar. You would be aware that that the British pound has fallen as a result of the country's decision to leave the European Communion, and Brexit has had a very strong depreciative effect on the British pound. About 25% of the global fund's assets reside in British pounds, so we own a lot of UK companies, and hence that currency headwind has actually masked the very strong underlying local currency performance of our investments. Notwithstanding, we're very pleased with a double-digit return, and I've provided the EPS forecast for our portfolio of business partnerships for FY17 and FY18, and I think that gives you a very tangible insight into the expected intrinsic value growth of the fund's constituent business partnerships. So we own 40 industrial business partnerships that are profitable, and the majority of these businesses we will expect to grow significantly over the medium to long term, and that will drive our fund's performance upwards, coupled with the fact that we've never paid fair value for any of those business partnerships. Just going to quickly go over this slide because I am conscious of time. I do believe that Australian investors remain severely underinvested in international equities. Historically, we've just had very little predisposition to investing in foreign equities, but I think anyone who's across the statistics will see that that global equities is one of the fastest growing asset classes for Australian investors, and I think it's important that investors have a balanced approach to their equity investing. And one of the key benefits of investing globally, and one of the key reasons why we launched a global valued microcap fund, is that there's just a huge array of opportunities than we have currently domestically available. For example, we own an EDM, an electronic marketing software company out of the United Kingdom. I don't know if anyone has heard of MailChimp or Campaign Monitors, but this business is a competitor to that, although it sits at a higher level on the enterprise value chain. And that is just a phenomenally high growth business with very, very strong operating margins. That business opportunity, that business partnership is just not available to us in Australia because the only like business is Campaign Monitors, and Campaign Monitors is a wonderful Australian company, but it just happens to be private. There's just no way that we could tap into or become business partners in Campaign Monitors. But having a global value fund allows us and affords us the opportunity to invest in some unique business partnerships and tap into long-term growth and some societal thematics that are going to be driving that growth. So I'm now going to talk about 3 specific examples in our global value microcap fund. This first example is a business partnership that we've actually exited. Now, when we deploy capital, we're looking to invest over the long term. So our time horizon is not a year, 2 years, 3 years. it's really a 5-year plus investment term. And if you look at our deep value microcap fund, we typically have a churn of that portfolio of around 20 to 25% per annum, which equates to an average investment period of 5 years. But even that 20 to 25% number is actually adulted, because a lot of our exits in our business partnerships are forced upon us through merger and acquisition. And that's exactly what happened in Skull Candy. Skull Candy, I don't know if anyone's gone into JB Hi-Fi and looked at the headphone section, but Skull Candy is a market leader in headphone and earphone products. So it's a consumer electronics business with vast global operations across Europe, Asia Pacific, and the Americas. And this is a product that we understood very well. We understand manufacturing and we understand retailing. And this was a business that had very good organic growth across all its core markets, including North America. It was a recognized leader. The business had, at the time that we deployed and we entered into the business partnership, had net cash assets of $45 million. When we bought the business, that net cash position equaled 20% of the market value at the time. We purchased the business at roughly 12 times NPAT earnings, and that's excluding the cash position. So once you actually netted off the cash position, we were paying 10 times earnings for a growing business that had strong brands. It didn't just have Skull Candy; it had other unique brands, a very strong balance sheet, and it was a microcap business that had very strong fundamentals. 8 months into our investment, the company became subject to a takeover battle, one by an industrial player and another one by a private equity fund. The consequent takeover battle saw a takeover price that represented a 50% uplift on our original local currency investment. And whilst we weren't looking to disinvest from our business partnership in Skull Candy, we were forced to do so under the acquisition, and that was our first exit through merger and acquisition. There has been another consequent exit through merger and acquisition, and though it's early days, we do expect the global fund, like our domestic funds, to come under significant merger and acquisition activity over the medium to long term. I'll get to the next company. This is eDreams. This is a current business we own in our global value microcap fund. This company represents 4% of our fund's assets in the global value microcap fund. eDreams is Europe's, or continental Europe's, largest online travel agency. So again, this is a business right at the core of our competency in terms of being able to understand the business model, the fundamentals, the driver for earnings. And it allows us the capability to have an insightful viewpoint on where we think this business will be in terms of a 5+ year context. When we bought this business at the beginning of the fund's launch, just over 18 months ago, we bought it at a price between 1.8 euros and 2 euros. To give you a feeling for this business listed, I think it was in 2013. It IPO'd in 2013 at an IPO price of 10.5 euros. So we're buying the business at less than 20% the original IPO price. One of the things that we were able to ascertain when we were listening to the conference calls of eDreams and listening to the sell-side analysts and the investment banks that were asking questions is that our investment management team felt some of the questions depicted a lack of understanding by the European investment community of online travel agency businesses and business models. And we think part of the reason why we would afford it a very deep value opportunity in eDreams was because there was a lack of understanding and appreciation for online travel agency business models at the time, and hence we were able to buy the business at really compelling price points. For memory, I think we paid 4 times operating profit on the business. The business has gone through significant leadership transformation. There's a CEO that's been installed, and he's been there for just under 24 months. This is a strong CEO who's done a number of key changes to the business in terms of improving customer transparency, in terms of improving customer satisfaction. They've improved their net promoter score. But we also understood that the online travel agency thematic, as it applies to Europe, which is a much more mature market than Australia from an online travel agency perspective, still lends itself to a significant growth opportunity. And we understood that one of the key thematics that was going to drive the organic growth in eDreams over the medium to long term was a societal trend where consumers were becoming increasingly familiar and comfortable in transacting their travel needs through an online travel agency. There is a clear, and has been, and this is obviously a long-term trend, clear shift from the bricks and mortar online travel agencies to the online travel agencies, and this is a thematic that we picked up on. I'm going to talk about a business partnership currently owned, but we're still in the accumulation phase. It's a tremendously exciting business. This business is involved in cyber security. It's a leader in endpoint detection and response, and without going to overtly technical matters, essentially what endpoint detection means, it sits rather than at the server or at the firewall end of a network, it sits at the user level, whether it's the PC, the tablet, the email program. This security detection, the cyber security detection, sits at the user end, whatever the mechanism the user is interacting with. And the interesting thing about the EDR market is that it's a huge growing market. It's growing at roughly 25% per annum. And this business that we have is one of the leaders in the EDR marketplace, and it's recognized as leaders by information technology agencies. And hence we expect tremendous organic growth out of this business. It's a profitable business. We expect the business to more than double its profits over the next 3 years. So tremendous organic growth. We think we've bought the business at a very large discount to the intrinsic value. Currently, this business represents 4% of the fund's assets, but we're building what we call a key core holding in this business, where it's going to be a top 5 business partnership, and we're going to apply 7 to 8% of the fund's assets in this business. Again, this is another example of the type of investment opportunity, the type of business partnership that you just can't find in Australia. There's just no cybersecurity software business available that's profitable and of this dimension and of this scale, and has this level of growth. So it's a unique investment opportunity that, had we not launched the Global Value Microcap Fund, I, as a personal investor in the Global Microcap Fund, would not be able to participate in. And it really is a really exciting investment case. I'm now going to shift and talk about our High Income Value Microcap Fund. Now, the title probably is a bit of a misnomer, because the title of this fund, High Income, kind of concentrates on the term income. But in reality, this fund is actually a capital growth income fund. The objective or the mandate of this fund is to deliver long-term capital growth, but to also supplement that capital growth with regular cash distributions. And this fund pays out an extraordinarily high cash distribution. It pays out cash distributions every 6 months. Now, this fund has been in operation for over 5 years, so we can talk about its long-term investment returns. I'm going to say a couple of things about the long-term investment returns of this fund. The first thing I'd like to point out is that it's clearly had significant outperformance to the All Ords Accumulated Index. I'm using the All Ords Accumulated Index. I could have used the Small Cap accumulated index where the outperformance would have actually been significantly higher. But to keep things simple, I've used the All Odds Accumulated Index, which takes into account, of course, total return, including dividend income. Now, the total return, compound return since inception of this fund, these figures are net of all fees, thereafter all our fees have been taken into consideration. We never insult our fellow investors by putting gross returns. These are always, all our returns we ever put out are always net of total fees. The compound annual return since inception has been 14.11%. Now that return number does not include the franking credits that we distribute to our co-investors. If we were to add the franking credits, it would bulk up the compound annual return to about 16.5%. And those franking credits are extremely useful to tax residents. And in fact, if you're in pension phase, all other things being equal, you'll actually get a check from the government being the differential between your self-managed super fund tax rate and the 30% that the franking credits have been allotted. Now, most equity income funds in Australia, and keeping in mind this is a capital growth fund, not just an income fund, but most equity income funds in Australia, if you look underneath the bonnet, are essentially all the four banks and Telstra are added in. And they adult their income by leveraging the fund and also selling options over the banks and Telstra. Our forecast grossed up dividend return, which currently sits at dividend return, which currently sits at just over 8%, is purely from expected dividend income to be derived by the 32 constituent business partnerships. That is, there is no adulterance with regards to the dividend income generating capacity of this fund. Our fund has two assets. It's completely vanilla in structure. It has cash and equities. Those are the only two assets. It doesn't use derivatives, it has no leverage of any kind, and we never short. So they're completely vanilla in structure. We've never missed a cash distribution. So if you look at the historical track record of this fund, we have regularly paid out our cash distribution commitments every 6 months, and we've got a perfect 5+ year track record. We're about to pay our next distribution in July, and I think when you look at this fund in the next 10 years, you'll see us maintaining that perfect track record of distributions. And why am I so confident that we're going to maintain that untarnished cash distribution payment history? Because we own 32 industrial businesses whose underlying business models underpin the security of that dividend income stream. If any of those 32 business partnerships should, for whatever reason, suspend or curtail their dividend program, it will not markedly affect our ability to pay our distribution commitments. So the underlying solidity and the security of the dividend income stream is absolutely phenomenal, and that's what gives me confidence that when we reach a 10-year track record, and I'm talking about this fund 5 years from now, I'll be talking about a perfect track record of distributions. So this fund, if you look at the cash distributions and franking credits that we've paid just under 54 cents in the dollar. So the fund started its life, we issued the units at $1. We've paid 54 cents in cash and franking credits, and you can see today there's also capital growth of around 44% added to those distributions. So if you invested $1, you would have received 54 cents back, and you're now sitting on an asset that is 44% higher than it was when you actually first bought it. I think it's a tremendous fund because it actually has achieved the dual mandate of delivering capital growth, and we've supplemented that capital growth with regular cash distribution. So how are we able to find and source high yield in industrial companies? Because I'm sure a lot of you are listening to me and thinking, well, microcap companies, you don't normally relate them to dividend paying companies. The reality is that 2/3 of our asset class is uninvestable. We wouldn't call it investment grade. So I mentioned that there's 2,300 listed entities. There's 1,600 of those are microcaps. Only 600 or 500 to 600 of those are profitable. So 1/3 of the asset class, only 1/3 of the asset class is actually profitable. Out of that 1/3, some of those businesses have incredibly solid businesses, and they're very strong cash generative businesses. And that's what we're trying to identify. We're trying to identify businesses that we think will grow over the long term. But unlike our growth value microcap fund or our deep value microcap fund that are indifferent to the dividend remuneration policy, in our high income value microcap fund, we do look at dividend remuneration policy. So there are really three scenarios that we typically come across, and that's how we actually access growing profitable businesses that are paying very high dividends. And I'm going to go and talk to each one of those. The first one is a classic microequities value scenario, which is it's an undervalued company. It's not intensely followed or researched by the market, and hence we're afforded an opportunity to buy at a deep value price point. And because we're buying at a deep value price point, the yield is very high. The second type of model or scenario is where we come across businesses that have an underlying business model that is not capital expenditure intensive. So if you think, for example, about a professional services firm, in order to expand, needs two things. It needs client-driven demand, but in order to satisfy that client-driven demand, it must expand its service capability. And in order to do that, it just hires more people. But it doesn't require capital expenditure in order to purchase property, plant, invest in research and development, technology. It's what we call a CapEx light business model. And hence, many professional businesses have very high dividend remuneration policies. And hence, we're able to tap into these very good growth businesses, but also these businesses tend to have very high yields. And a case example for that was Oakton Limited, which is an IT services company that we owned in our high income value microcap fund, and that business became subsequently taken over. But that was an example of that type of scenario. The third example is where we find a deep value opportunity, but it was typically a small cap company that has been battered down by the market value. It's an unloved business, but the market, in all its wisdom or lack thereof, has completely driven the market value down to a price point where there exists a very large gap between the intrinsic value and the market value. And at that point in time, if it meets all our other investment criteria, microequities will deploy capital and enter into a business partnership. And that's exactly what we did with What If, which is a business model we were well acquainted with. It was a business that we had followed for many years. We've been shareholders and business partners in Webjet for over 8 years, and What If was a business that we constantly looked at, and we were afforded that opportunity when What If fell from grace and it went from a small cap to a micro cap. At that point in time, we pounced on it, and I think 12 to 18 months after we deployed capital, Expedia also decided to pounce on it and launched a friendly takeover bid. I'm going to give now 3 examples of business partnerships that we currently own in our high income value microcap fund to give you a taste for some of the business partnership constituents. So the first one I'm going to talk about was Jumbo Interactive. Again, Microequities has a long association with this business. This is a business that we've researched in the past, that we know very, very well. We've been tracking for probably 10 years. We purchased this business on a FY18 price to earning of less than 9 times. The core business, which is a internet lottery business, has a strong growth digital thematic. Again, this is a similar thematic to the online travel agency space. It is about a long-term structural trend in consumer behavior, shifting their lottery purchasing habits to online, and Jumbo's been doing that for many, many years. They've built a wonderful technology platform that's very user-friendly and very slick user interface that consumers love. And because they've built that, they've been able to attain and should continue to attain very good growth as that consumer and structural thematic of a shift in the purchasing behavior of consumers from buying their lotteries in bricks and mortar to online continues over the medium to long term. Like many of our business partnerships, this business has no net debt. It's got net cash assets. We purchased the business at a prospective 8.8% grossed up dividend yield. We purchased the asset, I think it was just under 12 months ago, at a price ranging between $1.60 and $1.80. Currently it's $2.60. Since we became business partners, there's a German gaming industry company named Lottoland that's acquired 6%. And recently, Tats has acquired 15% of the company. Second example, and this example I've flagged here because it's going to give you a deep insight in one of the key risk mitigating pillars of microequities. So we bought Hunter Hall roughly around 3 years ago. And we bought the business at the time at an enterprise value of $40 million. So at the time, I think the market value was $70 to $80 million. The business had no debt on the balance sheet. It had cash and financial assets. Most of those financial assets, if not all, were investments in their own product of roughly $30 million. So the market value was $70 million. But the enterprise value, once you stripped out the cash and financial assets, was $40 million. Now, at the time, Hunter Hall had close to just over $1 billion in funds under management. And obviously, funds management business are right at the epicenter of our core expertise. We run a funds management business ourselves, so we are very well versed in being able to assess key fundamental features of the business model and attributes, and we're well placed to understand the likely evolution of a business in the funds management space. So key competency. We bought the business on a very attractive grossed up dividend yield of over 10%, and we bought it at a time in which its net outflow patterns were actually beginning to stabilize. The current share price today is $2.91, and in the period that we've held our business partnership in Hunter Hall, it's paid us over 60 cents in dividends. The company recently became subject to a friendly takeover tip bid by Pengana Funds Management. The interesting thing about this business is that it did not go according to plan. The chief investment officer and founder of Hunter Hall, Peter Hall, had a tumultuous, unplanned, and highly controversial exit through the business. It was, in my over 20 years worth of investment experience, the most chaotic succession plan that I've ever seen and probably likely to ever see. But notwithstanding the chaotic succession plan that Peter enacted, we were able to not only maintain a profit in our investment, but actually a substantial profit. And the reason why, despite a huge risk event crystallizing, and in fact an unknown risk event crystallizing, because certainly when we invested in the business, we thought at some stage Peter would retire, but we never envisaged that the succession plan would be enacted in such a disorderly manner or form. Despite that event, we were able to still make a very sizable profit on our investment. The reason why we were able to do that is because we never pay fair value for any of our investments. One of the key tenets we hold is that when we buy a business, when we deploy capital, the intrinsic valuation of a business must be at least 50% higher than the current market value. And what that does is it gives you a tremendous buffer should an unknown or known eventuality crystallize. And that is one of the key reasons, if you look at our fund's performance you will see that we typically have stronger outperformance in weaker equity markets than in rising markets. And that's because one of our key risk mitigation strategies is to buy everything at a large discount to the intrinsic value. So it's a very insightful example because it does show the effectiveness of our risk mitigation policy of never paying fair value. The last business partnership I'm going to talk about, I've actually had to withhold, and that's because we're still building the stake, and I don't want to unleash a whole set of competitors upon us and have some of our listeners chase a limited supply of equity out there. We've bought this business. This is a professional services business, so it's kind of the second scenario that I discussed earlier when I cited the type of scenarios that allows us to buy into these high yield businesses. It's a professional services business, so then it has a very low capital expenditure intensive business model. But we've also bought this business. It's at a very large discount to its intrinsic value because it's completely under the radar. The business has a market value of under $50 million, and what that does is, even for some of our microcap peer fund managers, they typically will not invest in businesses under 50 million market value. They will wait for that business to go to 100, 150 or $200 million before they can actually invest. At Microequities, we invest in businesses below $300 million, and we do not care how big they are at the time of deploying capital. They could be 5 million, they could be 10 million, they could be 20 million. We're investing with a viewpoint of 5-year plus. So we're not looking to exit in 12 months or 18 months. And if our investment thesis is well executed, in 5 years from now, this professional services business will be markedly bigger than it is today. So we don't worry about the scale or lack of scale at the time of deploying capital. This business has been purchased at less than 8 times price to earnings. We were able to buy a substantial amount of equity into this business in support of a strategic acquisition, where they've essentially the business has bought one of its competitors. At the conclusion of that acquisition, this business will be one of the top 4 companies in the market. There is going to be significant industrial cost and revenue synergies as a result of the acquisition. That hasn't been aggressively priced into our valuation of the business. The business has no financial debt. It's got net cash assets. It's going to be paying significant grossed up dividend yields. It has a very good business model that underpins the security of that dividend yield, and we look to continue to build a stake in this business, a significant stake, and this business will likely become one of our top 5 business partnerships in our high income value microcap fund. Just about out of time. I've gotten to the end of my slide, which has been no mean feat given I had to get through 19 slides. What I'm going to do is I'm going to now take some questions from the audience. For those that have typed questions, I'm going to select some of the questions and endeavour to answer them. I've received a question from the audience. Can you make your funds available to retail investors? That's a question from Alan. I'm sorry, Alan. Unfortunately, all our funds are only available to wholesale and sophisticated investors. So for a wholesale investor has a statutory definition of you either have to have at least $500,000 to invest in our funds, or if you don't invest, if you invest a sum less than $500,000, you have to have either net assets of $2.5 million or have earned net income of $250,000 over the course of the last 2 financial years. The only other entry pathway into our funds is through what's called the sophisticated investor. The sophisticated investor is a subjective test in which we assess your level of investment experience, your investment experience in the asset class, your understanding of the product's risk attributes, and your understanding of finance in general. And if we make a conservative determination that you do have sophistication, we will allow you entry into our wholesale funds. I've received another question from Jenny. At what point do you decide to sell a company? It's a great question, Jenny. The simple answer is rarely. We're in a business partnership, an ownership model, so we don't have a buy and sell model. Our model is ownership. So when we decide to enter into a business partnership, we're becoming owners, and we're not looking to sell anytime soon. In fact, our ideal investment is the best investments we've ever made are those that we bought 8 years ago and we still own today because they're formidable businesses. If we're fortunate enough to identify a JB Hi-Fi or a Cochlear, believe me, there's going to be tremendous long-term growth generating by these type of businesses as they grow into small cap companies, mid cap companies, and large cap companies. But in more specific answer to your question, what do the scenarios look like when we decide to sell a business? Well, the reality is that all the investments that we undertake, bar none, all have fundamental risk. I'm not talking about market risk because we don't consider that a risk. I'm talking about fundamental risk, so things that will undermine the ability of a business to generate revenue, earnings, anything that could, any risk catalyst event that could undermine that, and execute a poor form of execution by the management team. So when a company substantially diverges away from the original premise of the investment case, and we think that divergence is going to be long-term, we will decide to sever our business partnership and sell. Typically, Jenny, under those scenarios, we are going to take a significant loss of principal, and typically when we've encountered those scenarios, we've lost anywhere between 20 to 70% of our principal. Now, fortunately, we don't encounter those scenarios very often, but when we do, we're definitely going to lose a substantial amount of principal. That's one of the exit scenarios, probably the least palatable. Second exit scenario is sometimes the market is highly inefficient, both in an undervalued and in an overvalued sense. And sometimes the market pays us very, very high premiums to what we consider to be the fair intrinsic value at the time. And if the market is paying us very substantial premiums to fair value, unfortunately, we will sever the business partnership and disinvest. The third exit scenario, as you've probably gathered, is through merger and acquisition activity. And that's probably the biggest scenario that we face. I think about 40% of our business partnerships are exited through merger and acquisition. I've got a question from Simon. He's asking about what proportion of the global value market cap funds are in online travel agents. If we added, we own 3 online travel agencies across the 40 business partnerships we own in the global value market cap fund. At the top of my head, I think that would equate to roughly about 14% of the fund's assets. So 14 to 15% is the answer, Simon. It's obviously an area that we have expertise on, but really we've got expertise in in an array of areas. We own, for example, a retail furniture chain out of the United Kingdom. We've purchased that business because we've got significant experience in furniture retail, and we actually own fantastic furniture in our high income value market cap fund. But we've also got experience in software business models. We've invested many times and many years in software business models. We've had very successful exits. We own software businesses in our deep value and our high income value market cap fund. We've got deep industry contacts in the software technology space, and we understand software models very well. Got a question from Fetty. He's asking, does quality of management come into your research before, during your investments? Absolutely, great question. I didn't really focus on management team capability today, but it is a key part of our due diligence process, and I think that the importance of that cannot be underestimated. I mentioned that the key conceptual framework for when we enter into an equity investment is that we're entering into a business partnership, And I think any of you who have ever entered into real-life business partnerships, you would, one of the key fundamental elementary questions that you would ask yourself when considering a business partnership, aside from the underlying business and the financial metrics of that business and your view of that business, would be the quality of the management team. And when we're assessing the management team, we're actually assessing them on two essential criteria. One is a capability criteria. How competent are they in terms of their own business, their domain expertise in their respective industry that they participate on? How strong grasp they have of the market dynamics and their competitors? How capable communicators are they? How strong salespeople they are? Essentially, for the CEO, they have to be the strongest salesperson in any organisation. So these are all competency elements. The second criteria is what we call their moral and ethical compass. So we're assessing them as business partners in terms of how we think they will carry out their office. Do we trust the management team to act in a manner that befits their office? Are they going to execute their office, carrying out the shareholders' best interests at all times? And in our business, and I get asked a lot whether that is do we apply a systematic approach to making that assessment? I wish I could sit here and tell you that is essentially a systematic driven assessment. It's not. 90% of that assessment is judgment. And in our business, if you're going to be in the capital deployment business, if you're going to be entering into business partnerships, you have to develop a capability for assessing the moral and ethical compasses of the people that you're deploying capital with. And we've carried out many management interviews, over probably 500 through my investment experience, and we've developed a key competency in making those assessments. Okay, see if I've got any. I've got probably time for one more question. I've got a question from Jock. I've got a question for Jock regarding this is the last question I'm going to be taking. Jock is asking, do we expect the distribution yield of the high income value microcap fund to be roughly similar into the future? Are these the sort of dividend yields you are typically targeting? So I think that's a great question, Jock. What I can tell you is the distribution yield is affected by two things. One is the nominal amount of dividend income the fund attains from its underlying business partnership during the course of the financial year. So that represents how much cash we have to distribute. And the second bit is what the actual underlying unit price of our fund is, and that's driven by market values. On a nominal basis, sitting here today, we expect the dividend income of the high income value microcap fund constituents to be over 8% over the next 12 months. The actual effective distribution yield will depend upon the market value price of the fund, because our fund is marked to market on a monthly basis. So all other things being equal, if the fund's market value appreciates, Jock, you will see that grossed up distribution yield fall. It will be lower. If the market value falls, the distribution yield will actually rise. Like a bond, it has an inverse relationship with the market or face value price. So I can't predict what the market value of our unit price will be over the course of the next 12 months, but I am very confident that our forecasted grossed up the dividend yield of just over 8% is very likely to be achieved. And if you look at the historical pattern of distribution yields that we've achieved, you'll see a regular consistency between our targeted dividend yield and the actual distribution yield. I will also say that the distribution that we provide to our unit holders every 6 months is made up of not just the dividend income, but any net realized capital gains. So we don't just distribute the dividend income, but any exits that we have within the fund during the course of the financial year, any net capital gains we also have to distribute back to our unit holders. So I hope that gives you a bit of colour around what we expect the fund. But certainly what you should expect the fund to continue to do very, very consistently, it's to actually meet its cash distribution commitments. And I'm also very confident that over the medium to long term, the fund's dual mandate of capital growth will also be achieved. I'd like to thank everybody for listening today in this Queen's birthday morning. I think it's been a really interesting presentation. I hope you take some value out of it, and whether you decide to invest or not in our funds, I hope that the first two slides where I spoke about our investment process, but our investment doctrine and our viewpoint of equity investment as tantamount to a business partnership does resonate with you, and hopefully you're able to apply it in your own investments. So yeah, thank you very much for listening. Thank you.